All right, let's get right into it. The market is at an absolutely critical juncture.
Let's be clear. The window for early institutional positioning is closing, and it's closing fast. That recent market-wide liquidity event, that wasn't just some random panic sell-off. No, this was a calculated structural shift. And for any portfolios that weren't prepared, that represents a massive opportunity cost.
And this is where we see a critical disconnect, a real data discrepancy. While a lot of retail sentiment was reacting to what was happening on the surface, the price action, the underlying institutional data tells a completely different story. This was a technical market restructuring, plain and simple. It wasn't about a change in fundamental value.
So in this briefing, that's exactly what we're going to do. We're going to break down the key data points that were actually driving this volatility. And more importantly, we'll identify the critical technical levels you need to be watching for your forward-looking portfolio positioning.
All right, let's dive in. Point number 1. We need to conduct an analysis of the event itself, what I'm calling the Q1 liquidity shift.
And the scale of this thing, it was substantial. We're talking about a liquidity shift of $100 billion that exited the market in a single 24-hour period. Now, it's absolutely crucial to understand this wasn't some fundamental crash. This was a rapid, technical repricing event.
So how did this happen? Well, this slide really illustrates the mechanics behind that massive shift. The event was what we call a technical backfill. It was executed to close something known as a fair value gap. Now, what's that? It's basically a kind of market inefficiency that happens when the price moves super sharply in one direction, leaving behind a bunch of large, unfilled institutional orders. So the price action we just saw, that was a deliberate move to go back to that level, allowing those big positions to finally get filled. This is a classic feature of institutional market mechanics.
Understanding these kinds of maneuvers as they happen is absolutely critical to your portfolio strategy. Look, institutional updates move fast. You need to subscribe and hit the bell to make sure you get this research before the market has a chance to react. Okay, on to point number 2. Now we're going to place this liquidity event into the bigger picture, the broader macro-financial context. We'll do that by examining the key catalysts that are driving all this near-term market uncertainty. And when we look at the immediate horizon, there are 3 high-impact events you need to have on your radar. Each one is a potential catalyst for some pretty significant volatility. First up, we've got the Supreme Court ruling on tariff legality on January 20th that has direct implications for international trade. Second, later this week, we've got the Q4 GDP data release, a key indicator of economic health. And third, also this week, the core PCOE inflation data, the Fed's preferred measure of inflation. Trust me, institutions are monitoring these data points very, very closely.
So when you see this confluence of events, it really brings up the core strategic question for any portfolio manager, right? How are institutions adjusting their allocation strategies in response to all this data flowing in? Well, here's the key takeaway. They aren't reacting to this data. They are positioning ahead of it.
And that kind of forward-looking positioning, well, it requires real-time information. Video editing takes time, but the market, as we all know, doesn't wait. So for immediate updates and breaking news the moment it happens, you'll want to join the Telegram newsfeed.
All right, let's move to point number 3. To really illustrate this analytical framework in practice, we're going to drill down and examine the asset-specific price discovery process. And for this, we'll focus on the technical structure for XRP. Okay, so the key technical structure that we are monitoring right now is what's known as an inverse head and shoulders formation. Now, this is a classic chart pattern that, once it's confirmed, signals a potential trend reversal from bearish to bullish. For institutional analysis, this is an absolutely critical structural pattern. Why? Because it can indicate large-scale accumulation is happening at a market bottom.
So this pattern presents 2 critical technical levels to monitor. Step 1, we need to see confirmation of the support level at 194. A solid hold at this level is absolutely essential to maintain the pattern's structural integrity. Then, step 2, if that support is confirmed, we then observe for price discovery moving toward that primary resistance zone at 250 and even higher. You see? This gives us a clear, actionable framework for analysis.
Now, while that 250 level is the primary resistance for XRP, it is definitely not the only area of institutional focus. There are other key, higher resistance levels where significant institutional sell orders are very likely clustered. I analyzed those specific price targets right here.
Stay ahead in the crypto market. Subscribe now for the latest global news and updates. Tariff.